Well, good morning, everyone. My name is Mark Lyons. I'm the Director of Sales for Life Insurance here at SMS, and we'd like to welcome you to our monthly life insurance webinar. We do have a very special guest here with us today. This is David Goki. He's our Regional Vice President from Assurity, right here from the home state of Nebraska. And Dave is going to share some life insurance strategy ideas that are entitled uh, Payback, Build Wealth, and Sell Fast. And I think those are all things that are very important to us and to each of you that are on the call. Just so you know a little bit about David, he grew up in Columbus, Nebraska, and he currently lives in our home city of Omaha, Nebraska. He has three children. And of course, he's a true Cornhusker, graduating from the University of Nebraska at Lincoln. Bleeds Husker red like all of us do. David's got a little bit of a special background. He was actually a financial advisor for a period of time. Has worked for Waddell and Reed and Pacific Life before coming to Assurity. So he knows what it's like to be on the front lines of building wealth for clients, insurance strategies. He's done all the hard work. So I'm sure he'll share some of his insights regarding that as he goes through his presentation. So welcome, David. We're happy to have you.
And I'm happy to be here. Yeah,
Oh,
my fun little fact, back to your point about being a financial advisor, the very first insurance product I ever sold, obviously it wasn't that long ago, it was probably about 13 years ago, but it was an Assurity Life product. So I've kind of come full circle. And so
so
it's
you were destined
it was it
to
was it was meant to happen.
that's great. That's great.
Yeah, yeah.
So what are you going to share with us today?
Yeah, so I've got, I'll say, kind of 3 to 4 main strategies, and then a little bit of a teaser at the end that I'm not going to dive into too much, but obviously all your marketers know all about it. So again, they're a great resource. But yeah, we're going to dive into return or premium term and kind of some unique strategies there. Um, kind of the often forgotten single premium whole life strategy. And then we introduced a really, I think, impressive whole life product here. It's only been a couple months, I think, and specifically a couple strategies around that. So obviously, I'll touch on product, but it's really meant for strategies because, as you said, we're here in the business ultimately to help our clients, but also to make some money along the way. And so I want everyone to leave with some ideas.
Okay, that's great. Well, we'll dive into it. For everybody's information, this webinar is actually live. We're speaking to you right now. So if you do have questions, you can put them in the Q&A. Do not use the chat feature. Use the Q&A. I know sometimes when we sometimes when we have webinars, um, you're not able to ask questions. Excuse me.
I see there's already a question in there talking about how good you're looking there, Mark. So
Yeah. Yes. And the fact that I'm brilliant.
yes,
Thank you,
exactly.
Lisa. Thank you. I appreciate that very much. All right. Well, let's get into it. If you have any
Perfect.
questions, be sure to put them in the Q&A, and we'll get started. And David, I tend to interrupt,
I love
so
it.
I hope that's not going to mess you up.
Yeah, hey, you know what? If it does, it does, right?
Yeah.
That's part of life. So, well, again, thanks so much for letting me join. I think the number one question I get from top agents out there is, what are the very best agents utilizing when it comes to our products at Assurity? And obviously, that focuses on products, but as I had mentioned, it's really more about the strategies and utilizing our products in certain ways. And so, I think that was primarily the impetus for us coming together here today. So, we know a lot of carriers focus in on those really large cases, and I think what we're bringing today is something that I know pretty much everyone on this call is going to have a client or clients that these strategies can pertain to, and they're strategies that are a little bit niche. So it's kind of I guess, kind of illogical statement there in a way. But my biggest takeaway for you is to have you guys think of a client today. Please, please, please. That's my ask. That's the takeaway, because I know you will. I think there's some great opportunities out there. So first and foremost, who Assurity is. I'm not going to spend too much time on this. Again, we're based out of Nebraska. I think that there's something to be said for that. Here's to hope the Nebraska Cornhuskers will actually do something this year. But first and
Thursday
foremost,
night, baby. Thursday night.
Thursday night, fingers crossed. But we're a mutual company, and that matters, right? We are owned, and also as a result, accountable to the people that we insure. So by design, our customers come first. And I think that's probably the biggest takeaway. Yes, we've been around for 135 years, I think. We're a certified B Corporation, meaning that our focus is on working towards creating positive impacts in the community, in businesses, planet, et cetera. But I think we're well positioned, extremely well positioned. I'm going to show that here in the next slide. But the last thought on this slide is we don't outsource our customer service. We don't outsource our new business. And so you call in for either of those two things. The person you're talking to is likely 1-2 floors away from our CEO. And I think those sorts of things matter. So I know these numbers, there's a lot here on this slide. I know these numbers don't necessarily intrigue everyone. For someone as smart as Mark, probably does intrigue him. But I'll point out one specific number here, which is our RBC ratio. And that number gives us significant credibility when it comes to our financial summary. And so essentially, it's the best number to represent our ability to pay our claims. And for context, most carriers are around 400, 450. So Assurity being at almost 700% is extremely, extremely impressive. So before I go into the actual strategies, I'll say this. Obviously, we're well known for having some good commissions, but above and beyond that, to give you a little extra incentive, we're one of the few carriers that still has our company trips. And so qualifying for them isn't as difficult as many of our competitors, and they're really great trips. My wife and I, we just got back from Barcelona here not too long ago, and it was rather impressive. And kind of going back to what are our top agents doing, it's a really great opportunity to meet other top agents and to learn from each other and to share your ideas and great feedback. So that's just a kind of a good reminder here.
Well, that was a very good start, David. Just get the trip out front, and then everybody will pay attention.
Exactly, right? Yeah. But it's hey, when we were in Barcelona, staying at one of the best Ritz-Carltons in the world, that wasn't a bad thing right there on the beach. So I expect Maui will have probably a similar experience. So again, why are we here? We're talking about our top life solutions. Obviously we're here to help our clients solve their problems, even when they don't know they have one. Right. So I'm excited to share this. So I'll start with a return of premium. So it is, oddly enough, somewhat of a paradoxical sale. It is, return of premium is either referred to as kind of expensive or free when depending upon how you look at it. It's on average about twice as expensive as a normal term sale, or it's free, my air quotes if you're seeing here, it's free because you get almost all your money back at the end of the term period. So it's kind of funny when you're looking at it from that perspective. So, ultimately, when you're looking at term insurance, this is a great way to make sure that if you don't use it, you don't lose it. You get all your money back. It guarantees your money back, even if you don't die. So before I dive into more of the strategy side of things, let me give you kind of a baseline for the term product that we use with this. Right, we can go all the way down to 25,000. We can do that. We can go, it says 10 million. We did a $25 million return of premium here not too long ago. So it says 10 million. We go north of that. The biggest points, the biggest points I'll bring out is the accelerated underwriting and the potential for an instant underwriting decision. So with this return of premium strategy, depending upon your age, so if you're 18 to 50, we can go up to $1 million face amount and potentially have an instant underwriting decision. Now, they're still underwriting. Right? We got to be healthy to qualify for this. But I think that goes back to the process. We really want to try and make it easy for you. And I think we've done a good job with that. So kind of going back to the strategy, why return or premium? Ultimately, protection with a refund. It guarantees your money back if you don't die. So with our 20 and 30-year term lengths, you get all the money back minus an annual policy fee. So term insurance, relative to permanent insurance, is often seen as, I'll say, renting a home versus buying a home, right? We've all heard of that analogy. With return or premium term, it's like renting your home, but then you get all your rent checks back. If you're in that analogy, kind of, I think that's a great kind of look at what this does. Mark, I'm going to ask you a question. I know I've already asked this to you. We've had a conversation on this before. I'm going to ask you nevertheless. Feel free to answer it correctly. But the question is, what percentage of term policies actually pay a claim?
1 to 2%.
Yeah, 1 to 2%. Only 1 to 2%. Again, term, if you don't use it, you lose it. Now, we'll go into the importance of term, just basic term anyways here in a second. But if you Google it, Google says 1%. 1 to 2% is probably more accurate. But what does that truly mean? When you think about it, it does not mean that term life insurance is not important. It is. You are protecting what is truly important to you. Whatever it is, the reason that you buy it. But what it does mean is that there is a 99%, maybe 98% chance a normal term policy will not do anything for you. And so we can effectively reverse those numbers, or really make it 100%, where if you don't use it, it does do something for you in the sense that it gives your money back. So now the question is, real quickly, we're not going to spend too much time on this. Why is it 1%? Well, first off, you outlive your money, or you outlive your policy, sorry. That makes sense, right? It isn't anything too far-fetched. The older you get, the higher likelihood you're going to pass away. And guess what? You pass away after the term length. But what is the other top reason? Lapsing. We know clients often buy a term policy, and again, great solution. But 5 years into the policy, it elapses, or 7 or 10 or whatever it might be, they quit their policy. But the unique thing is, when you have a return or premium rider on that policy, guess what happens? People keep their policy. So this is, so listen up. This is a really intriguing thought. This is probably the most like brain teaser idea that I'm going to throw out there. So if it will either be confusing or it'll make sense. But when you add a return or premium rider, people do not lapse their policy. They do not quit their policies when you have return or premium. So ironically, it leads to an increased likelihood of us paying out a death benefit. Because if the client keeps their policy for that 20 years or 30 years, instead of the 10 years, there's a much higher chance they're going to pass away in that latter half of the term policy. So oddly enough, by adding the return or premium rider, it increases our chance of paying out a death benefit, which obviously is a higher ROI than us giving your money back. But it's an intriguing thought, and one that I think is worth obviously mentioning. So I often get the question, do I have to wait to the end of the policy to get the return or premium back? No, you do not. So what you see on the screen here, this is an example of a $500,000 death benefit on a 45-year-old. The premium is just under $2,400. And you can see, depending upon which year you quit the policy, or if you wait to the very end, you'll see how much we give you back. So it's, and especially if you note to the end, you can see how much we start giving you back, right? In that 28th year, you get $60,605, but if you pay your premium, the next year you get $64,000. Or $64,700. Who's not going to pay that $2,400 premium? Your clients are going to pay that. It creates that incentive, increases the persistency, and again, increases the likelihood. So I'm going to go through a couple of case studies with this. So this is, Mark, you're way smarter than me. This is what I think is kind of like a poor man's split dollar type of a solution. And I think it's really intriguing. So this client, single mother, Sarah, she has a small business. She wants to make sure she can send her daughter to college. So we wanted a simple strategy because she is a small business owner. So unlike split dollar, which requires an employer, legal requirements, tax calculations, Sarah buys a return or premium term policy directly from the insurer, and there's no need for contracts. There's no need for IRS compliance or shared ownership. It is a one-step hassle-free process. And by the age of 55, when her children are ready for college, she's going to receive that $30,000 refund, and it'll be a nice little start to help covering college. And again, it's that simplicity to let her achieve have her achieve the protection. And if she doesn't need it, there's, again, there's no bureaucratic overhead of the split dollar. It's just tailored straightforward to what she truly needs, and accomplishes everything that she needs. So I think that's
protection with the forced savings plan.
exactly. And that's a nice segue into this kind of case study. This is another great solution. It's kind of like a buy sell. I mean, really, it is a buy sell, but it's kind of like, I'll say it's kind of like a buy sell strategy where again, it's the forced savings. The funds are accumulated inside the return or premium. We know buy sales are not properly funded outside of, well, a lot of them aren't even properly funded with a life solution, but this is not quite the full expense of a permanent solution. And so we needed about $4.5 million of death benefit. Dad is bringing his, the 45-year-old is bringing his almost soon to be graduated college student into the business. And so he wants to be able to help his son buy him out at the end of the term period. And so there was consideration. Look, do we buy the 10-year or the $10,000 straight term, or do we buy the $20,000 annual premium ROP term? Well, the $20,000 ROP term is going to give him $600,000 to help with the funds buying them out later in life. And again, I think that's just a fantastic strategy. So kind of a little bit in closing on the return or premium, because again, I've got quite a few strategies and I tend to go long. So I apologize, Mark, if I'm a little bit on the longer side.
Oh, you're fine.
But the oversimplification of this strategy, right, which return premium isn't necessarily that complex, but this is just a great way to approach it with the client. Look, Mr. and Mrs. Client, we have an option. Option one, we can have a term solution and we're covering what we need from that life insurance perspective. And at the end of it, there's a 99% chance, you're probably not going to tell them that, but there's a good chance that, we get nothing out of it aside from the peace of mind. So you're effectively throwing away that $10. Option two, we have this other option where if you give me $20, I can guarantee you at the end of the term period, we'll have that $20 back to you again, while also achieving the same death benefit protection that we needed earlier. And oh, by the way, you as the agent just made twice as much money on the sale. I can't tell you, even when you don't think the budget allows for it, the oh, by the way conversation of bringing up return or premium on a term sale, so many clients love the idea. For those of you, SMS has a great long-term care team. Long-term care of old, and there's still some good solutions, right? It used to just be traditional LTC. Now a lot of it's asset-based, right? It's if you don't use it, you lose it. Same kind of approach with return or premium term. So keep that in mind. So kind of next. Yes.
And David, before you go on, I think we have a point of clarification we need to make for the Q&A. A comment was made about ROP greater than the premium payments, and that it's just the equivalent of the premium payments,
yes,
minus the policy fee. Exactly.
So usually we're going to give, we're going to give about 95 to 98% of your premium back. In that example with that $20,000 annual premium, it's going to be probably about 99.9% of the money that we give back. So we give everything back minus the annual policy fee. So you don't make money off of the design, although for a different time and a different day, I could talk. I'm a finance major. I love talking numbers. I can talk to you a little bit about the ROI of return or premium term, but for the sake of this conversation, you don't make money off of it. You just get all of it back minus the annual policy fee. Great question. Let's see here. So single premium whole life. So we're kind of transitioning into kind of strategy number two.
And one more question,
yes,
David, before you go on. So regarding, maybe a rider or probably would be a built-in rider. Is there anything that protects the person when they lose their job or something like that?
Yeah, great question. So for an extra rider, we could do a disability insurance waiver of premium, where we would take care of the premiums in the events that, you got disabled and lost your job. Additionally, we have a disability insurance rider that literally pays you. It literally pays you, not continues the product, but also pays you on top of it. So up to $3,000 a month. So there are a couple riders that you can add to make it a little bit more extensive to potentially address that concern.
Would you be able to add both?
Yes. Yep. You could add both.
Okay.
Great question. So next strategy, and these are great questions, by the way. So next strategy. So I think single premium whole life is often forgotten. I had mentioned that towards the beginning, and I just love it because you know exactly what you're getting, and there's no future obligation moving forward. It's one and done. You immediately increase your client's net worth upon their passing with accessibility to the funds along the way. And so going back to that analogy earlier, renting versus buying. With this, you're essentially buying a home outright. There's no mortgage. It's instant equity and lifelong home. Right. So I love the idea of that from a strategy perspective. So these are the nuts and bolts. We can go all the way down to a $5,000 death benefit on certain ages, as you can see on the screen. For 55 to 85 years old. It's non-med up to those ages and face amounts. But as far as the number one strategy when it comes to single premium whole life, far and away, it's policy rescue. Far and away, it's policy rescue. So what does that mean? So, first and foremost, with policy rescue, you have to be insurable, right? We've got to be healthy enough to be able to apply for a policy, right? And that's true of pretty much everything that I'm talking about today. We have to be healthy enough to get the policy. But policy review, in my mind, should far and away be a consistent solution you're providing to your clients. Clients change, their needs change, and change presents opportunity for you. So whether it's, hey, I'm in an IUL or a VUL, my risk tolerance changed, perfect. Got a one and done solution. It's guaranteed, no concerns moving forward. Maybe a client is, hey, you know what? I've been paying premiums in this policy for so long, it's become burdensome. All right, there's no more premiums with this single premium, 1035 into a single premium. The third one is we know there are solutions out there, whether it was a VUL, an IUL, a UL, even a whole life that was maybe oversold with higher interest rates, maybe pre-AG 49, whatever it might be. The as sold illustration isn't performing as well as the policy itself, and oftentimes really that might not even necessarily be to the market or the interest rate. Maybe it's just a lack of funding, right? They were sold the flexibility of a UL chassis and they didn't fund it. Perfect. If there's concern about the policy lapsing and there's still cash value in there, we can 1035 that into a single premium whole life. So policy rescue is far and away the number one solution. When it comes to single premium whole life, no surprise, but the best opportunity is for those clients who have a big chunk of money. And who are those clients? Typically the baby boomers, right? Baby boomers own 52% of the United States net worth. 52%. So that's $76 trillion. $76 trillion. So what are a couple ideas? Well, first and foremost, all right, here's an example. We've got $30,000 sitting in a CD. We're almost 70 years old, looking to pass money on to her grandkids or to grandkids to help with college. What's an example? So immediately and on a guaranteed basis, you can see her net worth. She put in 30,000. Her death benefit is 43. So essentially that means her net worth increased by $13,000. Imagine if you went to a client, you told them, hey, I could immediately increase your net worth by 13 grand. I think you're probably going to have their ears. Additionally, we have a rider. It's called our single premium insurance rider. Essentially what it does is it introduces more paid up additions into the policy. And you can pull that lever however much you want to. Now, in doing so, if you pull that lever all the way, you're going to give up some commissions. So something to be aware of there. But in doing that, we can make the policy look a little bit better. So instead of, you can see we have a $23,000 death benefit, or a $43,000 death benefit and $23,000 of cash value. So instead of 23 and 43, with this design, you can see same premium. Instead of 23, it's 27. Instead of 43, it's 50,000. So immediately we have a better looking design. Now, I like this. This is something we do see quite often. This is a 60-year-old female. She just lost her mother and received a nice inheritance. She wants to reciprocate that for her daughter while still having access to the cash value should she need it. So this is, we're pulling that lever about halfway, not all the way, as far as that paid up additions rider. And so $100,000 inheritance gets her over $200,000 of death benefit. Cash is there if she needs it in an emergency. I think this is a fantastic solution. If the primary impetus is having that money passed tax-free onto her kid, her daughter, this is a wonderful, wonderful solution. Now, going back to the point I had made earlier, right? Who's the #1 target for this baby boomers? I'm going to ask, Mark, I asked this question to you a couple of months ago. I can't remember the answer then. I'm going to ask it again now, though. Can you name half of your great-grandparents' first names? So every one of us have 8 great-grandparents. Mark, could you name just their first names, half of them? I can't remember how.
I can name half.
Half. Okay. So I read a statistic the other day, and by the other day, it was probably a couple of years ago. Most Americans cannot name half of their great-grandparents' first names, which is ironic because if you go to many of your clients, and many of you on this call, and you say, hey, what's your why? What's important? Family undoubtedly is the #1 answer as to the why. Yet if you think about it, we cannot even name, as most Americans on average, half of the first names of our great-grandparents. And I think that is kind of sad. So if you couple that, there's a saying, it might be, I think it's Egyptian, it's saying you die twice. The first time you die is when you die. The second time you die is when your name is said for the very last time. And if you or your kids or grandkids are the great-grandkids are the average out there, all of us will likely be forgotten when our grandkids pass away. And that's kind of a sobering thought. So this idea is kind of pulling on those heartstrings a little bit of let's make sure that we're not forgotten, right?
Yeah, usually our life insurance webinars are not that deep.
Sorry, Mark. Sorry.
But that's great. I mean, it really is good. A good thing to think about.
Yeah. So target market, right? It's on your grandkids. If we use this example right here, right? Let's say he's unhealthy, or even if he's healthy here in this, you can see the picture up there. What if, now this is a nice premium, right? This is the gift tax, $19,000. What if we put $19,000 in a one and done solution, and that buys $250,000 of death benefit for his granddaughter? Something tells me if he does this for his granddaughter, his great-grandkids will probably remember his name, because I'm guessing she'll probably talk about it. So that's a nice kind of closing and segue into our final kind of product ideas and solutions, right? Because I am going to be talking a little bit about juvenile life in a little bit more details. So we introduced 2 new whole life products, and there's a lot of push to IUL. There's a lot of push to a lot of other products. I think we created probably 2 of the best whole life products out there in the marketplace for a myriad of reasons. I'm going too long, so I'm going to probably go through these kind of the nuts and bolts of the product here pretty quickly to get to the ideas. But one of the things that we knew is clients wanted living benefits, and they wanted a really good living benefit story. And guess what? I think, nailed it out of the park with that. We didn't even have to pay. This was brought to us by an agent here not too long ago. And our marketing team was surprised because we had no idea. We thought maybe groups had to pay for these sorts of things. But Investopedia dubbed us the best living benefits for the whole life story. And we were thrilled and not necessarily surprised, but we were thrilled that our hard work was actually getting noticed. And I think it has everything to do. We have chronic, we have terminal, but we also have built-in critical illness ADBRs. And so we have 18 built-in accelerated death benefit riders. And I think it is really impressive because we want to create a product out there that, if needed while you're still living, we can help with that situation. If as I had said earlier, clients' needs, they change. And we want to be able to build a product that can adapt to those changes. And if one of these things comes up, you can choose to exercise it or not to exercise it and access cash value. It will eat up your death benefit, but I think it is a great story. Additionally, I talked a little bit about sales fast, right? We are really, really working hard to improve upon our processing. And so with these two new whole life products, we introduce a really great accelerated underwriting program. And I'll just go to the more the nuts and bolts, and you can see, depending upon the age, whether you're a juvenile, 18 to 50, up to $1 million, even if you're an 85-year-old, up to 100,000, we are not going to ask you to do a paramed. So I'm going to focus in here in a second, primarily on one product. If there's one product of the two, so we have two products. We have Perform Plus that leverages cash value. I think our Protect Plus is something pretty special. Now, when I went to the next slide, you can see juvenile whole life. I'm hitting on the last two strategies right now. Juvenile whole life, we have very much been a known leader in juvenile whole life. In fact, prior to this product, it was about 35% of all of our sales. But I think we created something pretty special, because with our juvenile solution for this product, it has a simplified underwriting process, and I'll expand on what that is in just a second. But real quick, let's talk about why juvenile life. I used to, back when I was a financial advisor, I didn't necessarily like the strategy. I thought it was maybe a waste of funds or whatever it might be. But the first bullet point is probably the biggest reason in my mind. As someone who lost my insurability in my mid-20s, if I wasn't in this industry and already practiced what I preach with a life insurance solution, I think of me. I think of those kids out there that are maybe getting diabetes or cancer or whatever it might be. There is nothing out there like life insurance. And the moment you lose the capability of buying it, it's not like there's another investment out there that you can purchase instead. And so locking that in, I think, is so, so important. Cost of waiting, there's something to be said for that. It's going to be cheaper premiums the sooner you buy it. We all know this. There's nothing there, nothing crazy there. Peace of mind. I thankfully have never had to deal with one of my 3 kids passing, but I have friends who have. And it is the last thing you want to have to deal with is talking finances on top of, obviously, the pain that is losing your kids. Show that you care. If you bring this to your clients, some of the, if you approach it the right way, your clients are really going to see that as caring. And maybe you'll stand out and be a little bit different. Stickier clients, this is, obviously this is a selfish reason. We know the more your clients are working with you, the stickier they become, more referrals come, et cetera. The joke at the end, kids need more toys. Guess what? No, they don't. Having an 11, 8, and 6-year-old, we are constantly trying to throw toys away behind their backs. Don't tell them that. And we love our kids. I think we do a good job with that. But instead of, hey, getting more toys, like grandparents, right? Grandparents, uncles, aunts. This is such a great way. Come together and put something together. They will thank you when they're in their teens and 20s, et cetera. So all that culminating into a couple ideas. Donna and Dale, they've got 4 grandkids, 4, 2, and 1. We get a $25,000 whole life policy with a guaranteed insurability rider. And all 3, did I say 4 kids? There's 3 grandkids. All of that for less than $500 a year, $415 a year. That is so inexpensive. And guess what? If you wanted to create something a little bit more substantial, $700 a year for $250,000. And as long as it's under $300,000, we don't even need to ask what parents have as far as their death benefit. And if it's under, going back to this design, if it's under 100,000, we don't even need the parents to sign off on it. The process for juveniles only, just for juveniles, it's 4 health questions. The application is simple. Still an application. If you're unhealthy, we're going to decline you. But we know most kids are healthy, and it's a pretty slick and easy process. So that was kind of going back to our Life Protect Plus and kind of the final strategy. Like we spoke about earlier, when Mark said, I'm going a little too deep, right? For me, family.
You're not going too deep. You're getting too deep.
You're getting too deep. We know family is important to a lot of our clients. We know that. That's their why. Now, it's not everyone's why, but it is most people's why. And the last thing I would say, kind of that middle America client wants to do. Wealthy clients, they've got a large nest egg, okay. But most Americans, they do not want to burden their kids and their family with funeral costs, because we know it through experience, children will, in an emotional state, they'll spend more than what they've got to make sure they're honoring their parents. That just happens. So making, this is a final expense alternative. This is the why. Now, this is not final expense, right? I'm talking about an idea that this is not. And I'll say that again, this is not final expense. And what I mean by that is if your client is unhealthy, go somewhere else. Choose a final expense product through, SMS has a ton of carriers with great solutions. But if your client is healthy, and they're willing to do a 15 to 20-minute application, this is very, very likely to be a better priced product and a better product in general with a lot of customizability and likely living benefits as long as we're buying the 70 years of age or younger. And in my experience, I'm seeing this product, again, if we're healthy, be about 30 to 40% less expensive than final expense solutions. And my point to that is it's not 30 to 40% less expensive. It allows you for the same premium to buy 30 to 40% more death benefit. And I think that is a solution that is worth bringing to your clients. But again, the two big things I'll point out, not final expense, we need you to be healthy. Go somewhere else if we're unhealthy, and a full application. It will take 15 to 20 minutes. So another point to keep in mind, we need to be under that 100,000. Now we can go, no, we don't need it, but if you don't want to do a paramed, we need to be under that 100,000 for that 66 to 85-year-old. For that 65-year-old, we can go up to $500,000 and have it be not that. And we can go up to 10 million if you have that. And that also is a kind of a good point. Upsell this opportunity if you need to. Maybe the conversation starts as final expense. It's now become more affordable. Maybe we can do a $200,000 death benefit instead of just that measly 25 or 50,000 that we were starting. So kind of, again, keep that in mind. Maybe it's now a 75, 100,000, whatever it might be. So I think it's a good reminder. So what is kind of some pricing on this? Well, this is a 65-year-old male, standard non-tobacco. We could, now this is a pay to age 100. We could do a 10 pay. We could do a 20 pay. We've got that cash value. We've got living benefits. As long as we're buying this 70 years of age or younger. Pricing, again, I think it's fantastic. One of the things that I brought up and someone brought up to me is the reduced pay up option. Let's say you're 10 years in and we want to create a reduced pay up option. Creates that flexibility. And if you have someone who's a lot healthier, instead of $95 a month, it's 85, because yes, we can get preferred and preferred plus on this, even if we're 65, 70, whatever it might be. So now I'm going to finish because I'm going too long and my transitions here are terrible for the sake of trying to speed up. So apologies. So I'm going to finish with kind of one final thought. And I've kind of been ignoring the questions pane, so hopefully I haven't been doing that too much. But the final thought is, it's kind of like but wait, there's more. So everything that we talked about today, everything we talked about has the capability to be utilized inside our foreign resident market space. Now, I'm not going to go through all the details. Again, this goes back to my original ask of make sure that you're reaching out to the SMS team because they have a lot of the details on this. But real quickly, real briefly, a lot of carriers focus in on those really large opportunities, minimum net worths of $1 million, whatever it might be. We are focused in on the middle market space. And you can see on this, we can cover Canadians, sure. If you have a certain valid visas, we can do that as long as you've been living here in the United States for 1 year. But that third category is the most intriguing and where we're getting the most interest. If you have a client and they have one of those government issued IDs that you can see on the screen, they're living inside the United States and have been living here for 5 or more years. Although, fun fact, I have it on good authority that we're changing that to 2 years here in the coming weeks. So that's going to open up a huge opportunity for us. Then we could look to underwrite those clients. Now, for the sake of this being recorded, I'll show you the eligibility. There's more details, right? There's certain elements and parameters. We do kind of filter this. There's certain business that we want and we don't want. But if you're intrigued by any of that, assurity.com/foreign-resident. Please visit that site because it's got some good details. So to kind of finish up, we talked about probably too much. So sorry, Mark.
No, no,
Um,
it's all been great. It's really has been great.
Good, good. So we talked about return or premium term, right? If you outlive your policy, you get your money back. Talked about single premium whole life, one and done. You're buying your house outright. Yeah, create a home equity line of credit kind of analogy, right? Day one cash value. Talked about the juvenile life solutions, and again, the why behind that. And I think there is legitimate reason for why. And then finally, not final expense because there's underwriting, but that final expense alternative. We can go over 50,000. We can go, as long as we're under 100,000, it's going to be non-med. And so I'll open up into questions here in just a second, but I'll finish with this last thought. I hope this was not a waste of your time. Now, why do I say that? Because even if you enjoyed or had some good takeaways, took notes from what we talked about, even if you had some good insights, I know for me, if I don't act on that today, now maybe all of you are way smarter than me, but if I don't act on that today, I'll maybe remember 10% of what I talked about, right? I won't remember 10% of what I talked about. So I would encourage you to act on it. If you don't act on it, it is going to unfortunately be a waste of our time, right? So think of a client. That's my ask. That's my takeaway. Mark, I think that's all I got.
So just let me kind of recap
Yeah.
kind of the notes I took. I mean, one of the big ones for me is mutual company. I've always been slightly biased toward mutual companies. I appreciate the financial security and safety. They don't go anywhere typically, but they haven't, or if they did, it hasn't been for a long time that they're going somewhere. And I really do think that in general they treat the clients very well compared to stock companies sometimes. You got the Hawaii trip, and then the return of premium, um, you know, and I thought that was fantastic about the number of the lapse ratios, and as people let term policies go, they're not paying out a benefit because it's gone, and it keeps that policy in the client's hands. Um, and really there's not a lot of companies that do really ROP as much as there used to be. So that's a great solution. Single premium whole life, um, you know, policy rescue after a policy review. SMS can help you with your policy reviews. You just reach out to your marketer, or reach out to our team, and then we can help you with that. I love the paid up editions. That was great. It's just an easy way to say, hey, I'm going to make this look a little bit better. I mean, it's going to cost you a little bit in commission, but sometimes it's well worth it to be able to do that. Help clients with their why, and having their names remembered for the future, so you kind of at least delay dying twice.
Yeah, exactly.
uh, the Whole Life Protect Plus, the fantastic living benefits. You've got the accelerated underwriting, with the juvenile. You can get up to a $300,000 policy for the juveniles. With no proof of parent insurance. And if it's going to be, but it's 100,000 or less or under 100,000, you don't even need the parent's permission or signature.
Right.
And the short pays apply to the juvenile too, don't they?
Correct. Yep.
And that's very key. I mean, if grandparents, if they want to take out a policy to kind of help the kids out as a Christmas present, rather than buying them jeans that year, they should probably get them a toy too. But just a policy and a toy.
No more toys. No more toys, Mark.
That's a great solution. And just the fact that you can short pay it, it takes away a lot of that objection of the policy having to have the kid be responsible for it when they reach age of majority or when the grandparents die. So I think that's fantastic. As a final expense alternative, if the client's healthy, you can buy more death benefit. And don't forget about the foreign resident middle market program. That's not something that carriers typically offer. And so, there's pockets of advisors and agents in areas that would be very, very beneficial. And so I think we could find great success with that.
Yeah. Well, I appreciate, let's see here. So questions, I do see a few. So does single premium whole life have LTC and critical illness rider? And what face value does it need to be for non-paramed? So I'll, for it to be a non-med solution, it's up to 700,000 a death benefit for anyone 60 years of age or younger. And then 61 to 85, we can go up to 450,000. But to go back to the first part of that question, as a reminder, we don't have any true long-term care riders, right? Mark, compliance mine's probably going off. I know mine is a little bit. It is a chronic illness, so that is on the single premium whole life as well. But the ADBR, the critical illness, is not. It's something that we're working on creating. But as of right now, inside just the single premium whole life, we do not have a critical illness option. I have a case now. Perfect. So does he go to non-fluid? So we have a case now for kind of the foreign residents. And would he go through the non? So it would still be the non-med. Now, depending upon which product, again, connect with the SMS team. Depending upon which product, it's a little bit, I guess, cumbersome in the sense that we force you to do a paper app. So plus one additional form. So work with the SMS team on that. Perfect. I don't know if there's, let's see. I don't know if there's really anything else. Mark, anything else you see?
No, I don't.
Well, please follow up with the SMS team if you guys have any questions. And
Yeah.
if ever needed, go ahead.
Yeah, as I was say, if the question didn't get answered, just phone up your life marketer, and if they don't know the answer off the top of the head,
They'll call me.
We'll track it down. And if you're new to SMS and you want to get contracted with a surety, you can go on our website, seniormarketsales.com, and click on the Get Contracted button. Or if you'd like to talk to someone, you can click on the Talk to Someone button. If you just want to call in, the life number is 877-888-0166. And that phone number is on the website too. So it's real easy. If you're on your phone, it just makes it very simple to get a hold of us. So, David, we thank you for joining us today. The presentation was great. You were very clear, very concise, actionable ideas, and that's just sort of the thing that we need. So, thank you everybody for joining us today. We'll have a recording of this call out in our life insurance resource, the place where we keep the webinars. So if you want to go back and look at it, otherwise, if you wanted us to send you a copy, we can do that too, or a link to the webinar. So thank you very much, and we'll talk to you again next month.
Thanks so much.